This week's episode is a little different. Odds on Open invites two guests, Nishant Gurnani and DeWayne Louis, two partners at Versor, a pioneer in applying AI and alternative data to global equity markets. Since launching in 2014, Versor has grown to over $1.4 billion in AUM.
We see ourselves as empirical market scientists, and so what we do in the research process is think very carefully about what it is we're trying to model and what sort of underlying data generation relationship is there.
We spend a lot of time evaluating alternative data sources. Alternative data for us is anything that doesn't fit in a nice neat row or table. So it could be words on a piece of paper, it could be an audio file, it could be credit card receipts.
To the best of our knowledge, no one else certainly does or models and thinks about these things this way. And one of the main novelties of our approach in the strategy also is it allows us to construct signals from a top-down macro view.
A lot of folks will train a model to look through data to solve problems. That's not what we currently do. We do use AI to help us solve specific problems that we've identified.
Which among your strategies have generated Versor the most gains, the most amount of edge?
I would say,
Hey, thanks so much for listening to Odds on Open. When I look at the back end of our YouTube statistics, I can see that only around 22.8% of you guys are subscribed. And I'd like to ask a favor. If you like the content we create and you do want to help us grow this show, get the best guests possible, and make our production quality higher, if you could consider hitting that subscribe button, I would really appreciate it. And I promise I will do my very best to bring you guys the best guests, the best conversations I possibly can. And by subscribing, you're helping us do that, and you're also part of our story. Thanks, and back to the episode now. Nishant, DeWayne, thank you guys so much for doing this. Versor manages $1.3 billion. We've seen so much change in the economy with regards to all these new technologies, Gen AI being one of them. How has Versor utilized specifically generative AI for generating investment success?
Ethan, thanks for having us on, and thanks for that question. It may be helpful to provide a little context as to who Versor is and philosophically how we view the world, and then I'll dive into how we think about AI, broadly defined generative AI, and kind of use of alternative data and data to help us solve problems. But we're a quantitative investment boutique that specializes in viewing and then analyzing the entire ecosystem of equities. So we look at equities from a single stock perspective. We trade on a market neutral basis around the world, are looking for attractive opportunities. We look at equities undergoing corporate events, focusing on hard catalyst events, think of merger, acquisitions, LBOs, and the like. And then we look at equities from the perspective of equity index futures, where we're investing in about 80% of global equity markets using equity index futures to evaluate attractive opportunities around the world. I would say in terms of how we think about AI and data that flows into AI, it starts first with the data. So we do spend a lot of time in evaluating alternative data sources. Alternative data for us is anything that doesn't fit in a nice neat row or table. So it could be words on a piece of paper, it could be an audio file, it could be footfall traffic, it could be credit card receipts. So anything that can give us interesting insights into companies in markets, we'll potentially look at. And the way that we look at it is by combining technological tools. So a lot of folks refer to this as AI, but very simply put, to the extent one is using alternative data, you need to have the tools in order to synthesize that data appropriately. You cannot run a simple statistical regression on a newspaper article, as an example. You need some sort of alternative AI tool, natural language processing, or other machine learning tools to help you synthesize that. Philosophically, the way that we think about AI is from a tool uses perspective. That is to say, we use it to help us solve a specific set of problems that is generated by a human being. A lot of folks commonly refer to this as supervised machine learning. And that is to say, for us, it's important for us to identify a problem that we're seeking to solve across the strategies I described, and then seek to find pieces of data to help us solve those problems, identify features within that data to help us train models, and then go forth and solve the problems that we're seeking to find. The important point that I want to stress there, at least from our perspective, it is the process does start with this human ingenuity and this human intelligence. There are a lot of folks that will train a model to look through data and parse through correlations or patterns in that data to solve problems. That's not what we currently do. We do use kind of AI to help us solve specific problems that we've identified.
So what you've mentioned there is the most important thing is human ingenuity in using these tools. Now, with regards to that, so with regards to human ingenuity, what does the pipeline look like for your top talent at Versor to be able to utilize all these different data sources, technologies in the best way possible?
Sure. So I think another way to describe human ingenuity in our context is we take a hypothesis-driven approach. We see ourselves as empirical market scientists, and so what we do in the research process is think very carefully about what it is we're trying to model and what sort of underlying data generation relationship is there. So in the context of alternative data, we look at data sets and we think very carefully about, is there something in this data set that may be helpful in forecasting the returns for the various instruments we trade? So credit card data is usually one of the easiest to describe because there is this clear causal link. If you can see greater sales for Nike in their credit card data, we expect revenues for Nike will increase over time, right? And that's a simplistic example, but it's really crucial to think about these things because given the explosion of data, there's so much data available out there. But if you don't come in thinking carefully about what it is you're trying to model, what do you believe is actually driving returns in the securities you trade, then it's a data mining exercise and you've lost the scientific human ingenuity and creativity. And so for researchers, the first step we do is we spend time thinking carefully. We write up a research specification. We ask and define very clear set of hypotheses as to what do we expect, what sort of relationships do we expect there to be, what are the sorts of things we would love to be able to capture and model. And the beauty with AI tools, and especially in 2025 and just in general, is our ability to capture these insightful, novel relationships that you simply weren't able to do 5 years ago even is completely amazing. So we can ask questions around, if I'm looking at jobs data, not only do I want to know how many jobs are companies going up and going down over time, but I can ask questions about what is the language they're using. Are there certain particular types of jobs that they are more likely to be advertising for? Is there been a shift in the way they're describing and the types of roles in the hopes that we believe that may tell us something about the companies themselves and their future growth prospects and ultimately forecast returns?
Now, what you mentioned there reminds me of, I think I was listening to the Founders podcast on Ken Griffin recently, and it was that Citadel, and he stressed this over and over again, are a research firm first and a trading firm second, and the trades are how they monetize that research. And I think that what you've said there gets to the heart of building a great quantitative investment management business, that fundamentally you guys are researchers, you are looking for these relationships, and trading is simply how you monetize those. Nishant, I'd just like to follow up on that. So you mentioned what these new technologies allow Versor to do. Our model is in modeling relationships that before would be very difficult to model. So you gave the example of jobs data. Now, I want to dig into that because you've mentioned, you can model relationships you haven't been able to model before. But you've also said that you come in with a hypothesis. Now imagine that these new technologies perhaps allow you to model relationships that are sort of nonlinear or that are difficult to pull out from pure common sense. And I was wondering, how do you guys at Versor think about that? When you go in with a hypothesis, are you able to shift gears and think, okay, actually, maybe these Gen AI models are pointing out something that we didn't think of before? And how do you go about modeling that?
Yeah, that's a great question, Ethan. And so I think that just gets to the heart of the scientific method. Just because we have hypotheses of relationships that we believe should exist is not a guarantee that there's going to be evidence suggestive of that, right? Sometimes we may hypothesize a certain thing is happening and the data may suggest something completely different. Having the hypothesis in the first place is what helps us think very critically of, is this relationship that we've identified in the data that is potentially nonlinear or different to what we anticipated actually there, realistic? Is there some actual mechanism driving this? Or is it something that was just an artifact in the data itself, right? So sometimes it's the act of thinking about what is driving the returns that promotes this scientific view on things, as opposed to, say we had not considered a hypothesis-driven approach. Say we decided to just apply a bunch of our forecasting techniques and NLP methods on this jobs data and found a bunch of stuff. As humans, we're very good at telling stories post-fact that, oh, this is exactly why that's the case. I was listening to your podcast with Rob Carver, and he talks about, he has this funny analogy of, if the most successful quant firm had been started by Yale history PhDs, we would all go back and say, Yale history PhD is really good for starting quant firms, right? So humans are incredibly good at finding patterns when they don't exist. And so the scientific hypothesis-driven framework helps at least guard against that. So that's step number one. And then step number two is we need to be very confident that whatever relationship that has been identified, there's enough statistical evidence to suggest that. So in the context of alternative data, a lot of the alternative data sets that are available aren't particularly long in history. And so that requires a lot of more careful thought. Is this statistically significant? Do I believe this relationship is going to hold and go on further? Or I don't have enough evidence to suggest that. If I have only a couple years of data, maybe there's an interesting relationship there. We'll watch it, right? We're not under obligation that we have to trade it immediately. As careful market scientists, that's a running experiment. This relationship was identified. I'm not sure I fully believe in it. It's counter to what I hypothesized might be the case. Okay, let me continue to collect evidence. We have a very detailed set of platform and infrastructure that allows us to run these experiments constantly and ask questions. And perhaps 6 months from now, we'll have more evidence and another explanation or an idea or an additional data set that may yield some insight that say, hey, actually, this result we found in this particular text data set using this model, we actually found it on another data set using the same model. So maybe there's something here. Maybe it's consistently catching the same pattern.
Yeah. If I might jump in and on that point, kind of around how we think about data and solving problems. If I can give just an example of kind of the event-driven portfolio. One of the opportunities that we look at is merge arbitrage, right? And folks think about merge arbitrage as having these binary outcomes. But when you look at the data, as Nishant is referencing, the data suggests that there are not just two outcomes in a typical merger deals, there's actually three, right? And that third outcome is that, the kind of the binary outcome historically has been the deal will succeed or it will fail, right? And vast majority of deals succeed, and occasionally some deal fails. If you look at kind of a passive return stream to something like mergers, you collect a few percentage points on deals that succeed, but the extent you have exposure to deals that fail, that can completely wipe out your gains, right? There's a third outcome in mergers is that deals succeed, but they succeed at a higher price. That is to say, there's an upward movement in the price or a competing bid, right? So look, when you look at the data, 92% deals succeed. Of that 92%, 16 of these deals have an upward movement or price or competing bid. Now let's go back to kind of how we think about framing a problem using data and building models. the important first step there that we take in looking and using kind of alternative data and using AI tools is framing the problem. So the problem in the case of merge arbitrage is not this binary problem that a deal's going to fail or succeed. It is that there's three outcomes, and we want to, as accurately as we can, predict the outcomes of those three different variations. So that's framing the problem. Then we look at data. So what data can we source to help us solve that problem? In the case of something like merge arbitrage, perhaps it requires years of curating a proprietary database of every announced deal around the world. And then from that database of deals, they can do some interesting things around identifying what are the attributes or features of deals that lead to increased probability of the three different outcomes that we're trying to identify. Right. So oftentimes in mergers, people look at spreads and say spreads are narrow or wide as indication that deals are safe or not. We think there are a lot of other attributes that we can assess, and we look through the data to assess those attributes. And then from those attributes, from those features, we can then train a series of models to help us predict the outcomes. And then we evaluate, and there's an iterative process. But I think the first step in that process, and what I think Nishant and I are trying to articulate, is being thoughtful around how you frame the problem, so as not to just solve for, an outcome that you desire, but really solve for the outcome that's feasible given the data that you're evaluating.
So you spoke a little bit about the merger arbitrage strategies you guys run at Versor and the fact that you frame the outcome into three different categories. I guess just for myself and for our listeners, what three categories are those? Like, how do you bucket the predict? What are you trying to predict when you're going through for an event-driven trading strategy like that?
Yeah. So for a merger arbitrage strategy, I think there are three outcomes, right? So historically, folks have viewed mergers as binary: success or termination. The third outcome, so we believe there's success, there's termination, but within success, there's two different pathways. There's a pathway where the deal completes at the agreed upon terms, in which case all is fine, and you collect that, whatever the spread was between the offer price and the stock price. But the third outcome is there's an upward amendment of price or competing bid. That is to say that there's another financial market participant that comes in and offers a higher price, or the management team negotiates a higher price for their company. When you look at the data, just statistically across all merger deals over the last few decades, 8% of deals fail, right? Double that amount actually has an upward amendment or price or competing bid. To the extent you're able to accurately predict those deals that are susceptible to an upward amendment or price or competing bid, we think that's an interesting advantage. And when framing our problem and the problem we're seeking to solve, we think it's very important to pay attention to that 60% of deals that likely have an upward amendment or price or competing bid that potentially can give you an edge in terms of return outcomes.
Fascinating. I've never heard the problem framed that way. And when I was reading one of the articles that Yash sent me, another partner at Versor, before this podcast, I found it fascinating that your model predicted a 40% likelihood of a competing bid for, one merger arbitrage deal. And that ended up happening, and it turned out to be a really profitable trade. DeWayne, can you walk me through that case study for our listeners? What was that? How did that go? And what was the process in building out that thesis?
Yeah. So that was a deal, without trying to get into the wonky aspects of the transaction itself, but it was a UK-based industrial technology company that was seeking to be acquired by one of his peers, competitors in the space. Ultimately, what happened was a financial sponsor, a large private equity firm, offered a higher price. And that deal closed at substantially higher price than the market was initially predicting. How do we go about analyzing deals like that? The first step is framing the problem. So the problem I just articulated was We're trying to solve for the probability of upper and minimum price of competing bid. But there's several other problems that we're trying to solve for in any given merger transaction. Another problem we try to solve for is the probability of deal failure. In a transaction like that, when we ran it through our models and conducted our analysis, that particular transaction had a really low likelihood of deal failure. That's really interesting aspect. The probability of competing bid, as you articulated, and we've published about this, was quite high, 40% probability. There are lots of features that we look at, without getting into the gritty details, that help us assess that. But one of the things that one might evaluate, with it's somewhat intuitive, is looking at deal spreads. A negative deal spread at announcement is an indication that the market thinks that there's likely to be an upward amendment or a competing bid. What's interesting aspect about deal spreads is that negative deal spreads actually have a very high cancellation rate for a number of different features. The third thing that we try to solve for is that we're not likely to get it right all the time, right? We work very hard. Occasionally there's something will go wrong in the case of owning a portfolio merger arbitrage deals. What we try to forecast there is, except we get it wrong, what's the downside? How much will we lose? An interesting thing to think about is, let's say a large pharmaceutical company is buying a biotech IPO, a recent biotech startup that has one or two technologies or a drug or so. It's very likely, to the extent that deal fails, it's not going back to where the stock prices was trading ahead of announcement. It's probably going to something close to zero. That's that's a very important feature that one that needs to care about. The third thing we predict, another aspect that we predict, is how long a deal takes to close. We'll come out with an estimate of how long the duration of a deal. To the extent it takes longer than that introduces another risk. The idea is, if two folks are taking longer to get married than they anticipated, perhaps they won't get married at all. And then we incorporated that with a forecast of volatility, right? So we want to get a sense for what's the path to closing. Most deals close. Not all deals close with the same glide path. We want to make sure that we measure that glide path. What's the volatility? What's the market risk associated deal, in order to size deals appropriately? So some of all those things that I mentioned, and I mentioned quite a few, and there are a few other things that I haven't mentioned, we come up with an expected rate of return and a risk level associated with expected rate of return. You can think of this as a Sharpe ratio Sharpe ratio, so to speak, with each deal. And then we want to go about optimizing our returns. So we increase exposure, have highest level exposure deals that are particularly attractive risk return profile. Exclude deals in a number of cases that don't have particularly attractive risk return profiles, and underweight deals and overweight deals based on kind of any variation of those things I mentioned.
Do you ever flip those signals? Let's say there's a deal that you have not only just, let's say, in the biotech space, and you don't just have little confidence, you have confidence that it's going to go the other way, that this might be going to zero. Do you flip those into shorts? And then I guess you kind of answered this one, but within maybe those longs and those shorts, not sure if you have shorts, how do you size those? Do you have a max size for any particular merger arb trade? Would love to hear it.
Yeah. So on the question of whether or not we go short the event, I'll differentiate that between short a stock. So in the case of merger arbitrage, we will be long the target and short the acquirer in the appropriate amount to extend as a stock transaction. So we'll always hold some shorts in the portfolio. In the case of the event, we always long the event. As I mentioned, 92% of deals succeed. The risk of getting that wrong is severe to the extent you're shorting it. That's not to say it isn't tempting. So it is quite tempting to potentially short particularly risky transactions. At the moment, we don't. We're actually doing quite a bit of research in using options and other mechanisms to potentially do that, but at the moment, we don't. The way that we go about sizing transactions is a number of different features involved in that. So one is kind of the risk return profile of any given deal. The second is the general merger environment. How particularly risky the overall environment is. One of the things that we look at is, deal spreads, so the mark-to-market risk of overall mergers. To the extent deal spreads are particularly, uh, volatile, there's higher amount of volatility associated. Deal spreads will take lower exposures. To the extent the inverse is true, will take higher. And then we look at the number of deals available to us in environments where there are lots of deals. That allows us to put a lot more bets across several different transactions. All feature into kind of how we think about sizing positions in terms of specific max positions. That varies over time based on the environments that I described. But there are rules in place that we do employ.
Fascinating. I guess now would be a great time to transition into the other strategies that Versor runs. And I remember in the pre-call we discussed a managed futures strategy that Versor runs. It's one of you guys' flagship strategies. And Nishant, I'd love to hear, from your perspective, what is that strategy and what are the benefits that it has over, I guess, trend strategies? Talked a little bit about how this one demonstrates positive convexity. I would love to hear it.
Sure. So one of our flagship managed future strategy is the GETT strategy, which stands for Global Equities Tactical Trading. And really, this strategy came about as a result of our internal research. We were very focused on offering a differentiated product in the managed futures space that really accomplished three main things. First, providing good absolute returns for our investors. Second, providing positive convexity. Convexity is defined in terms of how the strategy performs, particularly in equity down markets, but also equity bull markets. And third was making sure it was uncorrelated with the broader CTA space and the trend following space as a whole, which has the dominant amount of allocation in that investment universe. So this really came about as a result of our focus and internal research on creating something new and novel, and it's something we've been running for 8 years. And we're sort of happy to say it has achieved those things. It displays a tremendous amount of positive convexity, particularly in equity stress periods such as COVID. And it does this in a very unique and different way. So what is unique about the global equities tactical trading strategy? The first thing is it only trades equity index futures. So we trade 24 equity index futures globally. The second thing it does is instead of making directional bets, it's trying to identify relative mispricings between these equity markets. And so what it's really doing is asking questions around, is the S&P 500 more or less underpriced with respect to the FTSE 100, with respect to the Nifty, with respect to CACs? And what we found as a result of our careful and long research on the process is that this strategy that looks at and exploits dislocations in equity markets provides all these characteristics and is a very unique product offering because, to the best of our knowledge, no one else certainly does or models and thinks about these things in this way. And one of the main novelties of our approach in the strategy also is it allows us to construct signals from a top-down macro view, where we look at price and volume of the equity index futures. We look at dislocations between cash and futures markets. That's a large part of one of the key drivers of alpha in the strategy, where particularly during times of volatility, you will see significant dislocations between the spot cash market and the futures market as people are trying to hedge exposure. The second source of alpha we have is that we're able to construct signals bottom up from the individual stock level stocks in each one of these indices. For developed markets such as the S&P 500, this is reasonably easy to do. But for a lot of the EM markets that we trade, such as FTSE KLCI, MSCI Singapore, and Nifty and others, this is a very nuanced data exercise. We collect a tremendous amount of fundamental and stock level data for all these companies, and using our modeling skills and insight over the past number of years, we're able to construct these signals from bottom up and top down. And that's what really provides a market neutral, unique product offering that accomplishes all our goals: positive convexity, strong returns, and uncorrelated with the broader CTA space.
If these strategies that you're running are market neutral, how do you think about liquidity? Because I imagine the liquidity in the US markets, I mean, off the top of my head, I imagine it would trump maybe even all the other markets combined, just because everyone trades the US markets and it's the hottest thing right now. How do you think about that?
Yeah, we think about it in terms of risk exposure. So in a portfolio construction space, what you often think about carefully is legitimate liquidity constraints. So in EM markets in general, in the EM equity index futures, there isn't as much liquidity, so we don't run as much risk in EM markets as we do in developed. We run developed as a separate universe to EM. We run 12 developed on a cross-sectional basis, 12 EM on a cross-sectional basis. And it's not like there isn't liquidity. These markets are mature. This is something that we look at on an ongoing basis, and constantly looking at the investable universe, carefully measuring transaction costs, checking market liquidity is a constant process in what we're involved with. But really, the secret sauce of trading these things well is having a well-designed portfolio optimization process that accounts for these things in general. Because for systematic investors and quants in general, you know that oftentimes the alpha signals will be strongest in these less liquid, smaller markets. But that alpha is sort of a mirage because you can't actually trade those markets in the level of size and volume you want without moving the prices meaningfully. And so the key insight is incorporating a very thoughtful portfolio construction process that takes into account transaction costs and liquidity in real time to account for the position sizes you take in these markets.
Now, what you said there about not touching some of the really illiquid markets, emerging markets, can 100% attest. Now, I'm from the Philippines, and I think the volume of the Philippine markets on a daily basis is maybe just over 100 million US dollars, max $200 million. And so a fund like Versor, 1.3 billion, you wouldn't even be able to trade a tenth of that portfolio, maybe even a 5%. That could be difficult for you guys to get in and out of positions. And I can't help but think and be a lot more curious about how you go about, maybe not for emerging markets, but for markets where there's less data. You mentioned MSCI Singapore, less data than the US. How do you go about collecting a data set of strong signals, having presence really only in the US and India, and not being attached to these markets, I guess not understanding them to the same extent that you do others?
Certainly. So I think, again, it just goes back to having a very strong research-driven process. I don't think not having a physical presence precludes us from trading those markets. I think having expertise in equity index futures in general is the relevant portion here. One of the things that I like to emphasize, particularly to researchers at our firm, is that the systematic way that we trade and try to find inefficiencies is meant to try and extract global financial anomalies in market data. So what I'm looking for is, so let's take a very simple example. Let's take price momentum, which is a well-established anomaly where things that have gone up tend to keep going up and things that have gone down tend to keep going down. As quants, we're less interested in specific questions as to, is it only working in one country because of specific location or specific nuances. We're more interested in, here is this general effect that is being displayed in equity index futures markets because of the inherent behavior of how equity index futures markets trade. How do you find this effect in as many tradable liquid markets as possible? That's like a differentiation with regards to how we think about it. It's not completely wrong that we don't need insight into the individual security. So if I'm trading the Philippines, I want to think about what are the dynamics of what's going on in the Philippine Stock Exchange, whether there's any odd or specific behavior that would need to be modeled for, or would suggest that we maybe don't model it, right? So one of the most notable examples is that the way the dividends are handled in the DAX in Germany is different to how it's handled in other equity index futures. And as a result, certain signals will not incorporate because you have to think about those things. With regards to your question about how we go about sourcing data, we've been doing this for 5 or 6 years now. Actually, we've been doing it much longer than that. And so we've spent a lot of time collecting data both ourselves, but then also building relationships with vendors with high trust and reliability that we can utilize from. For quants, building signals from alternative data is an extension of the signal generation process. The things we look for are, is there good coverage? Is it point in time? Is it reliable? And in some of the EM markets, it's not there. And that's okay. But that doesn't mean we're not constantly talking to people, constantly trying to reach out and understand. Or if the situation arises, engaging with a local vendor to potentially collect specific stuff for us over time so that then future us can potentially use that in a meaningful way.
Now, interesting what you mentioned about building those relationships with the vendors, because obviously you guys are trying to get the highest quality data possible, highest quality information possible, to translate that into research, into trading edge. And I think that's probably a part of the quant business that I haven't heard that many people speak about. And it's very interesting that you say that. Now, moving on to the topic of just Versor's edge in general, and we've talked about those two different strategies, your merger arb strategies, as well as your managed future strategies, both of which are extremely interesting. For me, the merger arb one was particularly, like I read that article even just right before this, and I was fascinated. But I'd like to hear about not just all your strategies, but where have you seen the biggest gains? Which among your strategies have generated Versor, I guess, the most gains, the most amount of edge, depending on how you want to think about it? I guess, DeWayne, you can take this one.
Yeah. That's asking somebody to pick favorite child. That's we love all their children equally. I would say, when we started the firm 12 years ago, from the outset, the idea was to create a firm that had a diversified set of exposures. And the reason behind that, so we're a multi-strat. So we have multi-strategies that we offer. We're not a multi-strategy fund in traditional sense, in that you don't have a flagship multi-strategy offering like a number of other people that offer multiple strategies. Well, as a firm, holistically, we do have varied strategy offerings. And one of the reasons for that is that we do recognize that there tends to be a certain amount of cyclicality associated with various strategies. So Nishant and I talked about two strategies that are completely uncorrelated with one another. So Nishant described the GETT strategy that has done extremely well, particularly versus this other managed futures peer group. But that strategy has an explicit objective. It fits in their portfolios where folks are seeking to mitigate risk, right? This notion of positive convexity tends to express itself most during periods of high market dispersion, when there are more opportunities, cross-sectional opportunities across geographies to put relative value bets that Nishant is describing. Those environments tend to occur when there's heightened equity market volatility. When there's more equity market volatility, that strategy does better because dispersion is higher. Equity market volatility happens to oftentimes coincide with equity markets not doing too well. Now, that's an interesting attribute for one to have in one's portfolio, and that strategy does particularly well during these heightened stress environments, generally speaking. Now, the merger arbitrage strategy doesn't necessarily have the same convexity benefit, but it does well across multiple market regimes. What you can express there is event-specific risk, rather than taking a call on market or expressing ourselves using some sort of market dynamic. Is really looking at event-specific risk. But there's environments where those event-specific risks are particularly abundant, and there are lots of deals. There are environments where those event-specific risks perhaps are being dampened by something that's regulatory in nature or political in nature. Um, but the important thing in across all of our strategies and for Philosophic as a firm is to have a varied offering for ourselves, because the partners are significantly invested alongside our clients, and for our clients, so that's able to weather the entirety of a market cycle.
For sure. Like, I think running those multiple strategies is great for your own personal portfolio. Having those positive convexity strategies during equity turmoil, outstanding. And you touched a little bit there about founding the firm. I guess towards the end of the conversation now, but I don't think we have actually got to it. What was the story in starting Versor? How did it come about? Would love to hear it.
Yeah. Um, so the story started probably 3 decades ago. A number of us, including the managing partner, Deepak Gurnani, used to work at a firm called Investcorp. Investcorp is a large alternative asset manager focused on private equity, real estate, and hedge funds. Deepak was the founder of Investcorp's hedge fund business. It's actually an interesting anecdote. Maybe your listeners want to hear this. I oftentimes use the example of a popular movie. There's a movie starring Lady Gaga in which the plot, or maybe subplot of the movie, was that the Gucci family was selling the business. The acquirer of that business happened to be Investcorp. So Investcorp was on the other side of that business. And the hedge fund business at Investcorp was born out of the successful exit of Gucci. So Caspar purchased a portion on his balance sheet. So Investcorp found itself with the interesting problem of having quite a bit of cash on his balance sheet. And Deepak, who was at Investcorp at the time, was tasked with managing those assets in a hedge fund structure. So this is about 30 years ago at this point, over 30 years ago at this point. At Investcorp, we invested across the entire ecosystem of hedge funds. So we invested in the fund of fund business, a managed account business, an internal trading business. We seeded other managers, but underpinning that investment operation was a quantitative research initiative that Deepak and others started that was designed to understand the systematic drivers of hedge fund returns. I mentioned this research because it really acts as a precursor to what we're doing today. So a lot of the ideas, that implementation, are an evolution of 30 years of quantitative research that started back, I'll call it in the 90s, that sought to examine kind of what are those quantitative systematic drivers of hedge fund returns. A number of the partners worked together at Investcorp. 4 of the 5 founding partners worked together at Investcorp. The 5th founding partner was the head of operations, another large macro hedge fund. We came together 12 years ago to offer exclusively quantitative investment offerings to our clients, really leveraging decades of research in this space.
DeWayne, your background isn't specifically a quant background, is it?
No.
No, I'd love to hear about that. Unpack that, please. I'm curious.
I would say I'm a quant, a pseudo quant by osmosis. So I've worked with Deepak and Nishant and others around at the firm for the last 20 years. So I spent about 10 years, a little less than 10 years at Investcorp, working with Deepak and helping to build out the North American business at Investcorp, and then started here as a founding partner 12 years ago when we started this initiative. I would say I'm definitely not quant trained in the traditional sense. I spend most of my time articulating to clients what we do and how best we can serve them.
Fascinating. Now, Versor, founded by Deepak, if your founding partner, out of Investcorp. When I was doing research on Versor as a firm, I saw that, and I called Yash in the pre-call, and I noticed you have offices in both New York and in India and in Mumbai. Why is that the structure? Have you noticed advantages, I guess, from time zone, from a talent perspective, and even what can startup funds or just asset management businesses learn from that structure?
Nishant, why don't you go ahead and tackle?
Sure, I can speak to that. One of the backgrounds also is Deepak is my father, so I saw Versor before Versor existed, and so I have some different funny anecdotes from the early days. But with regards to your question with our India office, I think we wanted to have a global firm from day one. One of the founding partners, Nirav, is based out of the India office, and in order to having a global firm so that we can provide global coverage for all the markets that we trade, we felt it was very important to build a office that represented the cutting edge research that we do and provide folks the opportunity to do the type of research that they would be doing in New York as well. And so we have an extremely high caliber team there that we have sourced. A lot of them are IIT grads. A lot of them have PhDs in the sciences. There are a number of folks who on my team who are physics PhDs, and what it allows us to do is provide a dynamic global coverage for the markets that we trade, but also from a working perspective, it helps us increase this velocity of ideas that we're working on. So oftentimes, at least I can certainly talk about from my research perspective, we'll start the morning with meetings with the India folks. They'll sign off. We'll work through the day. By the time I'm signing off around 10 or 11 at night, they're back online. And so there is this continuous process of getting things done, and that's been one of the key advantages. In addition to just having this untapped talent pool that doesn't necessarily see these types of problems, but is well suited. One of the things that's very good about hiring folks who don't have on the research side a previous financial experience is that they provide new novel insights. They're not clouded by a certain way of thinking about markets. They can treat it empirically and scientifically the way we want them to from a scientific perspective. And really it provides us a tremendous global coverage.
You mentioned a couple things there. The first thing that came to my mind was your access to IIT grads. And I can attest, I'm doing the master's in financial engineering, and there's some IIT people who are using it as a platform to recruit, and they are extremely intelligent, and I'm blown away. And I think access to that talent pool must be tremendous for you guys. And the other thing that you mentioned that I find very interesting is your emphasis on trying to attract talent that doesn't necessarily have the financial experience, because it allows them to treat these problems in quantitative research as pure mathematical scientific problems, and they're not clouded, as you've said, by by existing notions of the way markets should be traded. I guess one of the things that I'm now very curious about is your hiring process. How do you screen for top talent? How do you identify top talent? Because I imagine, obviously having a PhD is great. Doing academic research is great. It might very well be an indicator of success in the quantitative research domain. But obviously it's not a one-to-one thing. Would love to hear it.
Yeah, so I do all the quant researcher recruiting at Versor, and so I myself don't have a PhD, so it's not like the PhD is a requirement. I think the requirement is to do world-class scientific research. And so the way our process usually starts is I will have a phone interview with somebody, and what I'm really interested in is learning about the research that they've done. Um, Usually it's in the context of a PhD, potentially in a project, but I'm really trying to dive deeply into the problem to ask whether they've done this in a thoughtful manner and are really thinking about things from first principles. And I've asked interesting questions because asking interesting questions about markets is what we do on a daily basis. And so someone who's thoughtful and who's spent a lot of depth thinking deeply about a problem they're working on is particularly well suited, and that usually comes out very quickly in a conversation about something that they've done that is of relevant. They need to have experience working with data. It's as simple as that. They need to be very core competent programmers. I think being a very strong software engineer is a baseline requirement as a quant. Even with the use of LLMs and stuff, just having that engineering maturity makes you much more productive, allows you to access things and be more contributing to the firm as a whole. So yes, we do technical interviews. That's not unique to us. I tend to do a real-time technical interview that's pretty challenging, and that sets the bar pretty high. But the first thing that really we screen people for is, have you done some sort of data analysis or research project? And if you have, can you articulate carefully about what's going on? And specifically, can you think about the business problem that you're solving? Because anybody can run a model and spit out some results. But have you thought very carefully about what it is that you're modeling in the first place? How does it relate to the ultimate problem you're trying to solve? What is the business case in the case that they've not done a finance project, that it's something related to something else? What it is that you've done, and can you thoughtfully articulate that? Because we operate in a global setting, uh, we do also emphasize communication. I think being able to communicate your ideas very effectively is an indicator of depth of understanding. So that's another thing that I'm certainly looking out for.
I think that that process of taking this top talent and really diving extremely deep into their intellectual exercise of research. No, I can fully agree. I think that's a great way of screening for top talent, because um, you really find how they think. You really figure how they think, the flaws and whatnot. And I guess I'd love to hear your thoughts on the way that the let's call them big multi-managers or top quant funds recruit today, straight out of university. I'd love to hear from both Nishant and from you, DeWayne, of this very much brain teaser, raw brain power ability approach that I see, and I see it very prevalently, especially in the way that you have these businesses popping up that essentially sell an educational tool on how to crack the interview. That they see the interview as a thing to crack in a way that I don't think it directly translates into doing the job well. Uh, if you can solve all these different probability questions and you've grinded them for 6 months, 8 hours a day straight, I don't see how that translates into being extremely thoughtful about the way the markets work. I guess that's for trade. That's from a trading perspective, and maybe for research it's different. But even so, but I'd love to hear your thoughts on that.
Yeah. Maybe I'll speak philosophically, and maybe Nishant could talk about a little bit more details. I think philosophically, you know, going back to what we articulated, where we view our edges, we think we do have a particular edge in kind of using alternative data, in a thoughtful way. And we think we have a particular edge in combining kind of human intelligence with the use of kind of these technological tools. I think philosophically, what we recruit for and folks that work with Versor, where they distinguish themselves as they move out the ranks within the firm, is their ability to really use uh, unstructured data and think about the uses of unstructured data to solve problems in a thoughtful way. So philosophically, we really like men and women who, either through their academic pursuits or perhaps the professional pursuits, have encountered problems where the data sets didn't come in a nice package. So whether that's observing the relationship between two stars, as an example, we have a couple of astrophysics physicists at the firm, or looking at chemistry or biology problems in a thoughtful way. The ability to parse through data, combine that with the use of technology, some level of programming skills, is probably the most important attribute to us. That being said, we recognize even with our best intentions, it's not going to be a perfect fit every time. So, when we look across the firm, we have about 60 people, about 13 or 14 partners. At the partner level, there's a lot of stability. There isn't some intentional turnover at the levels below that, because it takes a while for both us and some of the folks with whom we engage with on the employee side to sort out whether or not this is the right fit for the skill set. So that process is continually iterative. By the time folks have been here for a few years, we come to find that fit works, and so we have a lot of stability at the highest levels, at the partner levels of the firm.
Yeah, I may talk about the technical component that you raised, Ethan. I think there is a technical baseline for the type of work that at least quants, and I'm going to speak on quants' behalf, do, that does require a certain level of mastery. It's also true that there aren't that many seats in this business. There's not that there are tens of thousands of openings in this very competitive business. And so some level of filter is necessary. One of my filters for programming ability is what I call hands on the keyboard, where if I make you do live data analysis problem, I can tell within 2 minutes if you are comfortable in your environment. And it's just a requirement in order to do this effectively. And so which technical screening is good, not good, I'm certainly not going to opine on. The firms that do use the probability questions have a long track record of succeeding, and that seems to work for them. I prefer to test problems that are more similar to what they might encounter at work, but that's a philosophical difference, and there's inherent noise in the process. What DeWayne alludes to, I think, is actually a little bit more important, which is having the technical baseline is one thing, but trying to screen folks for the right mindset and attitude for this type of work is actually, I think, the harder problem, and that's sort of what it takes. And I think these intelligence tests are often a weak model to do that. So someone who's willing to grind probability questions for 6 months is also the person who's really competitive and wants to work hard and compete in these markets that are inherently competitive and has a sense of high agency to get stuff done and make progress. And those are sort of the harder things that it's difficult to describe, that ultimately people are looking for. People want intelligent people with high agency. How we source those differs by role and skill set and philosophy. Different firms will have different philosophies. Some firms love great poker players because they believe that is a great insight. So it's not for me to disagree. I think it's a noisy model to evaluate talent ultimately.
Yeah, I think what you mentioned there about it, these funds trying to screen for intelligence and agency, and maybe probability questions not exactly being the best gauge of being passionate about the problem, but people being willing to grind through those problems for 6 months exhibits those traits. I think that's a great insight. And just to wrap things up, we've talked throughout the conversation about the strategies you guys run at Versor, the story, even just now about recruitment and talent and being a global operation. And I guess with all this, I want to hear if you had to say one thing, what would you say is Versor's success factor? What makes Versor special? Both of you guys, I'd love to hear it.
Yeah, so I would say our success factor is, I think being true pioneers. I mentioned our Genesis story that goes back over 30 years ago. True pioneers in the use of things that people call AI today, right? And I think AI is defined, is evolved over time. So true pioneers in the use of alternative data, uh, advanced quantitative methods, uh, and decades of deep research in this space. I think that what truly differentiates us versus some of our peers.
I was going to say what DeWayne was going to say, but I will add to that. I think the second thing that differentiates us is that because of our research-driven focus and DeWayne and Deepak and the other founders' tremendous client focus, we have a very unique product offering. And that is one of our edges in that we have constructed strategies that meet client needs, but aren't sort of existing and oversaturated in the marketplace. So we spoke about two on this call. There aren't that many quant merger event-driven approach strategies out there. I think that's a tremendous source of differentiated edge. The GETT strategy is very unique in how it approaches the managed futures space. And you'll find even with our other strategies in each space, we have taken the time to use the AI and machine learning tools and apply them in a very specific way that not only fits client mandates and needs, but is also uncorrelated and a differentiated approach to markets compared to our peers.
Amazing. Well, thank you so much for doing this, Nishant. Thank you so much, DeWayne. I really enjoyed, and all the best. I hope you have a blowout year this year.
Appreciate it. Thanks. And this has been great. So congrats on launching a phenomenal platform, this podcast. I've been following it closely. So congrats to you, Ethan.
Congrats, Ethan. I'm an avid follower, so I look forward to listening to all future episodes as well.
Amazing. Thanks so much, guys. All the best.